Hi, I'm Ian Stewart, Chair of the Board of Leithner Company, and it's my very great pleasure to welcome you to our quarterly presentation covering the performance of Leithner Company up until April of 2023. Today, you will hear from our co-managing directors, Mr. Chris Leithner and Mr. David Guy, in a discussion that again demonstrates positive outcomes for our investors. My fellow director, Mr. Chris Safdropoulos, will facilitate this presentation. Over to you, Chris.
Thanks, Ian, and welcome to those joining us. Before we begin, please review the disclaimer by pausing the video. Today, we'll be going over the following. We'll be looking at the long-term and shorter-term performance of the investment company, going through some of the changes to the portfolio this year, where there's been 3 purchases and 1 sale. We will also discuss the significant event of the first quarter, namely the banking crisis that's hit the US, mainly regional banks in the US. And finally, we'll recap a little about the investment metrics and how to find out more if you are interested in investing with us. In terms of performance, over to you, Chris.
Thank you, Chris. Let's turn to the slide headed Performance versus Benchmark since inception. It makes 3 key points. First, it plots our investors' fortunes since our inception. Each dollar invested with Leithner & Co. in 1999 has snowballed to $6.33 on the 28th of April of this year. That's assuming the reinvestment of dividends, which we've declared without fail for each half year. So an investment of $500,000 in 1999 would be worth about $3.17 million today. The second point is that over the same interval, each $1 invested in a portfolio that mimics the All Ordinaries Index has grown to $5.82. That's also assuming the reinvestment of dividends. So an investment of $500,000 in the All Ords in 1999 would have been worth about $2.91 million on the 28th of April. Thirdly, we've outperformed not by generating big short-term gains, but by avoiding big and long-lasting losses. In particular, the All Ords plunged during the global financial crisis, whereas we fell hardly at all. It's true that we flatlined for a couple of years before the GFC. Basically, we prepared too early, but the All Ords accumulation index took almost 7 years to return to its pre-GFC high, whereas we took little more than 1 year to recoup our small losses. So let's turn now to the next slide, headed Performance versus Benchmark, Short and Long Run. It continues to compare our results to the All Ordinaries. The comparisons are since 1999, since January 2020, and since April of last year, and it expresses results as compound annual growth rates, CAGRs. Since 1999, an investment in Leithner & Co. has compounded 8.3% per year, and an investment in the All Ords 7.9% per year. Since January 2020, Leithner & Co.'s CAGR, about 7%, has exceeded the All Ords, about 5%. Finally, our CAGR over the past year is also about 7%, whereas the All Ords is about 1.5%. The key thing, we've written about this extensively, is not to record large short-term gains. It's to generate steady positive results. Steady positive short-term results accumulate into benchmark-beating long-term results. In other words, we're the tortoise in the race against the hare, and we know which one won in Aesop's fable. Okay, let's turn to the next slide, entitled Extremely Conservative Asset Allocation. Since 1999, our portfolio has been extremely conservative. Equities have averaged 48% of our total assets, and 58%, beg your pardon, in April of this year. Since 1999, non-equities have included at-call and term deposits, bonds of various descriptions, collateralized debt obligations we purchased during the GFC, and hybrid securities. The key point is that we've outperformed over 20 plus years, not despite, but because of our conservative asset allocation. Among other things, over the past several years, our large holdings of non-equities have enabled us to collateralize some very conservative derivatives operations that generated good income at good risk. Right. Next slide, please. Changes to portfolio during 2023. 4 things to say here. First, during this calendar year, we've trebled from a low base our holding of the Charter Hall Long WALE REIT. It's marked CLW in the first square. It's a REIT, that's to say a real estate investment trust, which holds a diversified portfolio of real estate. Its portfolio has a long WALE, weighted average lease expiry. In plain English, it owns properties which it rents under long-term leases, and these leases generate a secure stream of income. At the prices we've paid, we're expecting a distribution yield a bit above 7% during the next year. Second addition, during the past month, we've begun to add Elders Limited, ELD, to our portfolio. It's a rural services icon founded in 1839, but for much of the time since the 1980s, it's been a corporate plaything. Over the past decade, though, it's returned to its roots as an agribusiness pure play, and since 2016, it's generated excellent results. Last November, its CEO, who's been the architect of its resurrection, announced he'll be retiring, and since then its shares have skidded about 40%. We think that's a gross overreaction, and we're very happy to buy its shares from pessimists. Through the execution of put options we wrote late last year and early this year, we've increased our holding of Insignia Financial, that's IFL in the third square. Its business model is transitioning through the acquisition of a large business from ANZ and of MLC from the National Australia Bank. It's transitioning from variable to more stable streams of income. We research all of our investments thoroughly, and our research of IFL concludes that it possesses the financial strength and the managerial depth to transition successfully. Meanwhile, we reckon its shares are cheap, and we're happy to buy them from pessimists. Fourth point, final point, in March, we sold our stake of QBE Insurance Group. Actually, we wrote a very large call option over the entire holding, received a big premium. The option executed, and we received a realized capital gain. We were happy to sell to optimists. Our detailed analysis concluded that QBE shares have become overvalued. So those are the major changes to our holdings during 2023. We'll turn to David, who will take us through what's probably the biggest development on overseas markets so far this year.
Thanks, Chris. Yeah, I think we've all read about it in the papers. We've had a significant banking issue in the States, certainly the largest we've had since the GFC. We've had banks like Silicon Valley Bank, Credit Suisse in Europe, First Republic in America, and overnight, as we're talking, Pacific Western are running into problems in the US. So they've been forced to merge or be bailed out. There will be more of these. It's going to keep happening. The issue is quite significant. So how big is it? It's about $1.7 trillion US, which is a significant amount of money. The funny thing about banks, though, is that we consider them to be the safest investments in the world, a paragon of stability, but they are very, very heavily leveraged. So an average bank will lend out at least 10 times its capital. So if they had $1 billion of capital, they would make loans of at least $10 billion. The other side of that coin, though, is if they have losses of 10%, then all of their capital would be wiped out. So if you had $10 billion of loans and you lost 10% of those, all of your $1 billion of capital would be wiped out. So the rough figures on the US market, as I said, are that there's mark-to-market losses at the moment of about 1.7 trillion, which is roughly speaking the entire capital of the US banking sector. So we do have some major issues over there. What caused it is an unusual scenario. Well, unusual in the sense that it's near enough to the opposite of the GFC. What we had in the GFC was bad credit quality. So banks over many years had built up loans and investments that weren't good quality. We've read, the books on it. We've seen the movies on it. In the US residential property market, basically at one point they were effectively giving loans out to people who didn't have a job, no income, no jobs. So the credit quality was very bad. What we have today isn't that. it's a scenario where the risk of credit or default isn't anywhere near where it used to be. What we have at the moment is a liquidity issue. And it's caused by two things. As I've said, the banks generally are highly leveraged. The other thing that's causing the problem we've got at the moment is rising interest rates. So if you think about if you own, for instance, a 5-year US government treasury bond, for all intents and purposes, that's effectively risk-free. If you hold it for the 5 years, you'll get your money back. The problem is if you're not able to hold it for the 5 years. So if you bought a treasury bond when it was yielding 1% and then tried to sell it when rates had risen to 5%, you'd be showing a capital loss. You know, if rates rose very quickly like they did last year, you could be showing a 15% capital loss on a mark-to-market basis on a US treasury bond. So that's kind of where we've ended up. We're talking about high quality assets, but because interest rates have risen so far, anyone who bought these assets at low yields is showing a capital loss. So it's a scenario that's playing out across banks globally. Most particularly at the moment, it's showing up in US regional banks. And what we've got is a scenario where the mark-to-market losses, not credit losses, but mark-to-market losses caused by these rising interest rates have, in essence, wiped out the capital of the US banking system. So there's no credit risk. It will be okay over time, but at the moment, if they had to sell the assets, they're not worth what they need to be. So the problem with banks, as we all know, if you're a depositor to a bank, you're actually a creditor to them. You're lending money to them, and deposits can be withdrawn at any point in time. So on that US government 5-year treasury bond, if they're able to hold it for 5 years, they'll get their money back. But if a bank doesn't have enough liquidity, is required to sell its assets now, then they'll be showing these capital losses. And that's where we're finding major problems in the US. So it's a different scenario to the GFC. If things are able to transition or able to be held together for a period of time, the credit quality is there underlying the investments. But if things are forced through, we're finding problems like we've had recently, where you know, bank runs are happening in the regional banking sector. In terms of the effect on us, look, at the moment, our view is that it can be managed, particularly through deposit guarantees. The main risk with this scenario is a run on the bank, a classic run on the bank, where depositors get a little bit nervous about a particular bank and withdraw their money. The thing we're finding in this crisis is that that's happening a lot quicker. Because of online banking and these types of things, runs on banks are happening over a day. In the case of Silicon Valley Bank, I think there was a withdrawals in one day of $50 billion. So we're talking about significant runs on the banks, which might have happened over a period of months, but it's now happening over a period of days. Again, though, a deposit guarantee will fix a vast chunk of that. If depositors have no major risk or no major fears, then they're not going to cause these runs on the banks. So at the moment, if credit quality doesn't deteriorate, we don't see major problems for us, and particularly for the investments we own. On the other side, increased volatility can be good for us. So increased volatility will increase the premiums we receive on options. Generally speaking, it will also result in some more bargains for us to buy. So investments we would like to buy will likely show up at lower prices if there is a bit more of a crisis. So it's a major issue. We do believe it's a manageable issue, but the newspaper reports on it will be pretty dramatic at times. Bad events will continue to happen.
Thanks, David, and thanks, Chris. I guess to summarize, the investment company is well positioned with cash and investments that have favorable upside. And just to go over some other metrics for the investment company, current NTA is at 98.4 cents per RPS. Application and redemptions are made at that monthly net tangible asset backing. The market capitalization of the portfolio is 28.5 million, and there'll be a soft close at around $100 million. If you'd like to find out more, please contact either Chris or David to find out more about the portfolio and how we go about investing shareholder funds. And if you'd like to actually apply, there's a information memorandum on the website. And that's all from us.